After studying this module, we will be able to first understand the concept of primary market. Secondly, analyze the different pricing methods of initial public offerings. And thirdly, understand the concept of initial public offerings grading. We shall commence this module by studying about the meaning of securities market. Securities market are a very important segment of the financial market. They provide the financial resources needed for the long-term and sustainable development of the different sectors of the economy. The securities market is divided into two segments, the primary market and secondary market. In primary market, shares of companies are sold from companies to the investors. In the secondary market, the shares are sold from one investor to other investors. The primary market is also called the new issues market, is of vital importance in the economy of a country, as it leads to better utilization of otherwise inactive or dormant savings in the economy. Thus, in case of primary market, transaction takes place between companies and investors, whereas in secondary market, transactions take place among investors. The primary market, though distinct from the secondary market in many ways, but has an important relationship with the secondary market also. The shares which are sold in primary market are subsequently traded in the secondary market. It is therefore very important that the price at which shares are sold in the primary market should not be significantly different from the prices at which they are traded in the secondary market, at least for some period of time after their listing on secondary markets. In case the prices in the two markets are significantly different, it indicates that pricing of securities have not been correctly done. If the prices in the secondary market are quoted significantly below their prices in the primary market, the investor of primary market loses confidence and may refrain from further dealing in the primary market. The role of the primary market is to mobilize and sustain capital funds in the economy in the long run. For this to happen, it is most important that incentives be maintained in the right way. The maximum incentive must be for the long run, somewhat less for the short run, and the least in the immediate context, which is post-listing. In this module, we have an emphasis on primary market only. We start with knowing the meaning of primary market. Our primary market, or one can say particularly our initial public offerings market, that is IPO, has gone through a prolonged sluggish phase, especially the 2014, which has witnessed the lowest amount of money raised in a decade. IPO market means change of status, being a private company to become a public listed company. The IPO company raise money from the investor to achieve their objectives. Sometimes a company has good project, but they do not have enough funds to execute that project. They went to public and issue shares. It is the market in which a company directly sells the shares to the investors or public. It is a market where a new company raises the funds from the general public through the sale of shares. The sale of shares is made at value predetermined by the firm issuing the security. The price at which the security is sold to the public is the offer price or the issue price. The issue price could be equal to or greater or lesser than the face value. If issue price is greater than face value, the share prices are said to be sold at a premium. If issue price is less than face value, the shares are said to be sold at discount. If issue price is equal to face value, the shares are said to be sold at par value. The shares which are issued in primary market have a face value. The face value represents the denomination of the shares. For example, face value of 1000 or 500 or 10 or 1000. The main role of primary market is to mobilize and sustain capital funds in the economy in the long run. Therefore, it is important that incentive given to the investor be maintained in the right way. The maximum incentive is for the investor who invests for long term, somewhat less for the short run and least for the investor who invests for immediate context, that is the listing, gains or losses. Now we are moving to the methods of raising finance in the primary market. But before we discuss the main methods of raising finance from the primary market, there is always a question why companies go for public issue. Let us first understand the different methods of raising finance and the requirements why the companies go to the public to raise finance. We have different objectives like to raise capital, to increase credibility and gain trust, to be more visible to its clients, for image building and publicity, for prestige issue, to give an exit route to the private equity holders. Now the companies may raise capital in the primary market by public issue. So when an issue or offer of securities is made to new investors for becoming part of shareholders family of the issuer is called a public issue. The most important method of issuing security is by issuing prospectus to the public. If the issue has been made for the first time by a body corporate, it is known as initial public offer. The securities which the companies issue for the first time either after incorporation or on conversion from private to public are called initial public issues or initial public offerings. If issued further to procure funds for modernization or diversification or expansion, such issues are called further issues or seasoned issues. Now obviously one wants to know the eligibility or norms for public issue. An unlisted company can make an initial public offering or IPO of equity shares or any other security which may be converted into or exchanged with equity shares at a later date only if it meets all the following conditions. First, the company should have net tangible asset of at least rupees 3 crores in each of the preceding 3 full years, that is of 12 months each, of which not more than 50% is held in monetary assets. Second is, the company has track record of distribution profits in terms of section 205 of Companies Act 1956 for at least 3 out of immediately preceding 5 years. And the third, the net worth of the company should at least rupees 1 crore in each of the preceding 3 full years of 12 months each. Now we start discussing that public issue can be further classified into 2 types: initial public offerings and further public offerings. We start with initial public offerings. Initial public offerings market means change of status being a private company to become a public listed entity. The IPO company raise money from the investor to achieve their objectives. Sometimes a company has good project but they do not have enough funds to execute that project. They go to the public and get the issued shares. The most important method of issuing security is by issuing prospectus to the public. If the issue has been made for the first time by a body corporate, it is known as initial public offering. The second type is further public offering. The further public offering involves the companies whose share is already listed in the stock exchange and again they come out with the public issue, that is, it is called a further public offering. The second type of public issue is private placement. Under private placement method, a company can make an issue of securities to a group of persons not exceeding 200 as per Companies Act 2013, and which is neither a right issue nor a public issue. It is called a private placement. Now we are going to discuss about the pricing methods of initial public offerings. The pricing plays a very important role in determining the success of an issue. The issue of pricing of initial public offering can be studied by taking two regimes separately, that is, pre-liberalization, that was governed by the Controller of Capital Issues era, that is before 1991. Post-liberalization, that is governed by Securities Exchange Board of India, generally known as SEBI, and this era started from the year 1992. We start discussing about the era of CCI. In CCI era, initial public offerings were priced through CCI formula. Under this era, the firms were required to take approval from the Office of the Controller of Capital Issues for raising capital, and the CCI used to fix the size and price of the IPO. Then come the SEBI era. A major initiative of liberalization was the abolition of Capital Issues Control Act 1947 in May 1992, when SEBI was formed. In SEBI era, many reforms have took place, and book building was one of the reform which changed the pricing method of IPOs. This concept has been originated under the chairmanship of Y.H. Belgaum in 1995. The two periods can be studied from the point of view of different pricing methods. Now we are going to discuss different pricing methods of IPO. The first method is fixed price method. It is a traditional method of pricing the IPO. Here the issuer and the merchant banker agree on the issue price before making the actual issue, and the investors are required to fill in an application form at this price and subscribe to the issue. Second method is book building method. Book building method is basically a price and demand discovery mechanism. SEBI defines book building as a process undertaken by which demand for the securities proposed to be issued by a body corporate is elicited and built up, and the price for such securities is assessed. For the determination of the quantum of such securities to be issued by means of notice, circular, advertisement, document or information memorandum or office document. Book building is a process wherein the issue of securities and the issuer of security determine the requirements of the investors, and the investors are asked to give or bid for this particular securities or other securities at different prices. The features of these bids are: first, these bids are within an indicative price band decided by the issuer. Secondly, here investor bid for different quantity of shares at different prices are given. And thirdly, considering these bids, the issuer determines a cut-off price, which is the price at which the securities are allotted. The advantages of book building process are: first, to issuer, the issuer get the best possible price for its securities as perceived by the market of investors. It is advantageous for investors also. The investors too have a choice and flexibility in terms of having a say in pricing and a greater certainty of being allotted what they demand. Now here we also want to know types of investors. According to book building process, there are three classes of investors that can bid for shares. First is retail individual investors. The investor can apply up to rupees 2 lakh in the retail individual investor category. They have an allocation of 35% of shares of the total issue size in book building IPOs. Second category of investor is high net worth individuals. Individual investors, NRIs, companies, trusts, etc. who bid for more than rupees 2 lakh are known as high net worth individuals. They have an allocation of 15% of shares of the total issue size in book build IPOs. Third type of investors are qualified institutional buyers. Financial institutions, banks, financial international institutions and mutual funds who are registered with SEBI are called qualified international buyers. Qualified international buyers have an allocation of 50% of shares of the total issue size in book build IPOs. Then we also should know what is underwriter of debentures or who does underwriting of debentures. First of all, we should know the meaning of underwriting. Underwriting is an agreement entered into by a company with a financial agency in order to ensure that the public will subscribe for the entire issue of shares or debentures made by the company. This financial agency is known as underwriter, and it agrees to buy that part of company issues which are not subscribed by the public in consideration of a specified underwriting commission. Underwriters get their commission irrespective of whether they have to buy a single security or not. If an issuer is not able to get subscription, the underwriter should come forward to subscribe the entire issuings. Then we have the second type of underwriting is hard underwriting. Hard underwriting is applicable when an underwriter agrees to buy his commitment at its earlier stage. The underwriter guarantees a fixed amount to the issuer from the issue. Thus, in case the shares are not subscribed by the investor, the issue is devolved on underwriters and they have to bring in the amount by subscribing to the shares. We have soft underwriting also. Soft underwriting is when an underwriter agrees to buy the shares at later stages. As soon as the pricing process is complex and complete, he then immediately places those shares with institutional players. The shares are first offered to the public. The underwriter comes into picture only if the subscription is less than 90%. Now, after discussing everything, we should know IPO's grading. One of such important development in IPO's market in India took place in 2007 when SEBI introduced the concept of grading of IPOs and made it mandatory from May 1, 2007. According to SEBI, IPO grading is a service aimed at facilitating the assessment of equity shares offered to public. However, IPO grading is not a substitute for investor judgment and it is not a buy or sell recommendation. The Indian stock market regulator SEBI is the first in the world to make IPO grading mandatory for all the unlisted companies. IPO Grading Scale. IPO fundamentals are graded on a scale of 5, that is from 1 grade to 5 grade, as given below. We start with IPO grade 5. IPO grade 5 implies strong fundamentals. IPO grade 4, it signifies above average fundamentals. IPO grade 3, average fundamentals. IPO grade 2, below average fundamentals. IPO grade 1, poor fundamentals. Now we are going to discuss the objectives behind IPO grading. There are different objectives for the grading of IPOs. The very first is that IPO grading helps the prospective investor to take better decisions because the unlisted companies do not carry any track record that can help the investor to assess the market performance. This IPO grading is like an additional input to the investor. The second advantage involved in this is investors in unlisted companies have limited access to the information about business prospects, risk associated, etc. Even though that information is given in the prospectus, investors may be unable to analyze that information. But the IPO grading scale as displayed in the prospectus is easily understood by everyone. The third objective behind this is the grading scale gives a clue about the credibility of the issuer company. The fourth one involves that it helps in saving resources of the investors, as they do not devote their own time in analyzing or interpreting the fundamentals of the company. The fifth objective underlying this procedure is that IPO grading helps the issuing company in establishing credentials and raising funds at attractive prices by creating an informed, positive image associated with different levels of grading. And superior grading helps the IPO company to increase the extent of its subscription. The next objective involved here is that IPO grading is an initiative to ensure the investors' protection and to make the capital market more attractive, vigilant and logical. SEBI has also made IPO guidelines and grading optional from the year 2014. Earlier in 2007, it has made mandatory for all companies who has come out with initial public offer to grade their IPOs with registered credit rating agencies. But now this process is optional. Then we have certain new reforms in IPO market. First, SEBI has made compulsory for all companies with post-issue capital of less than rupees 4,000 crore to sell 25% stake or stocks worth rupees 400 crore, whichever is lesser to the public. If an IPO of rupees 400 crore size is not equivalent to 25% of the post-issue capital, the minimum public shareholding of 25% has to be achieved within 3 years of listing. Secondly, SEBI has also made IPO grading optional from the year 2014. Earlier in 2007, it has made mandatory for all companies who has come out with an initial public offering to grade with registered credit rating agencies. Now we have certain IPO reforms in the pipeline. The first is that SEBI is planning to introduce a concept of e-IPOs. It is a mechanism of offering shares to the public online without much documentation. The second reform is that SEBI is looking to bring down an IPO timeline from T+12 to T+6. At present, the time gap between submitting an IPO application to listing of shares taken an average 12 days. The idea of short-term period is to allow flexibility to investors to protect their money in case of fluctuations in market trends. Now we are going to make a summary of what we have discussed so far. We have seen that in order to raise money, we have two types of market, primary market and secondary market. Primary market is the market in which a company directly sells the shares to the investors or public at large. Then we have discussed the methods of raising finance in the primary market. The first and the foremost common method is public offerings, where an offer of securities is made to the new investors for becoming a part of shareholders family of the company is called public offerings or first time or initial public offerings. Then we have private placement. Under private placement method, a company can make an issue of securities to a group of persons not exceeding 200 as per Companies Act 2013, and which is neither a right issue nor a public issue. It is called a private placement. Public issue is further divided into two types. initial public offerings and further public offerings. Initial public offerings involve issuing securities by issuing prospectus to the public. If the issue has been made for the first time by a body corporate, it is known as initial public offering. The securities which the companies issue for the first time either after incorporation or on conversion from private to public are called initial public issues or initial public offerings. But when an already listed company makes either a fresh issue of securities to the public or an offer for sale to the public, it is known as further public offerings or seasoned public offerings. Then we have discussed the process of book building. According to the process of book building, three classes of investors can bid for the shares: retail individual investors, high net worth individuals, and qualified institutional buyers.